Imagine waking up every morning, rolling over, maybe checking your phone, and yeah, seeing your bank account has actually grown while you were sleeping. That fantasy, right? That absolute financial dream. So really the core appeal of passive income. It sounds kind of exclusive, like some secret club.
Yeah, a bit.
But really, it's just about smart money moves. Moves designed to, decouple your time from how much you earn.
And that's exactly what we've been digging into this week. We've looked at, well, a whole stack of sources laying out 15 powerful, proven ways to generate income that doesn't need you clocking in hours constantly.
Right.
So our mission for you, the listener, isn't just to rattle off a list. It's about giving you a clear, structured map, a bit of a strategic guide to navigate these different paths.
Okay.
We're really focusing on how they work, the mechanics, maybe some hidden risks, and importantly, the real effort involved.
Yeah, that's key.
Because whether you're a student, working full-time, a parent, juggling everything, these ideas are flexible, but they do need some precision. They're not magic.
Okay, let's unpack this. Before we jump into the actual 15 strategies, we really need to establish the goal here. It's about financial freedom,
Right.
like making smart moves with your money.
Exactly.
But maybe even more importantly, we have to tackle the biggest, most persistent myth around this whole topic right away. Our sources. They were absolutely unanimous on this one point.
Oh, yeah.
Passive income is not instant. It's just not. It's not like winning the lottery overnight.
Precisely. And that's the crucial thing to get, the caveat that separates the dreamers from the people who actually make this work.
Right.
When we say passive, what we really mean is income that keeps flowing after the initial heavy lifting is done.
That's setup.
Exactly, the setup. Most of these ideas, particularly the ones using your skills or creativity, they need a significant chunk of time or maybe capital invested up front.
Yeah.
You're basically front-loading all the effort.
And that initial effort, I mean, it can be.
Yeah.
It can be huge. Can you give us a practical example? What does that actually look like?
Okay, sure. Think about the digital asset side. Let's say you decide you want to create a really good online course.
Okay.
You might spend, 100 hours scripting it, filming it, editing, getting it uploaded. That's incredibly active, focused work.
Yeah, definitely not passive at that stage.
Not at all. The income from that course, it only becomes passive maybe 6 months later when people are signing up while you're off doing something else entirely.
Right.
One of our sources had a great way of putting it. Think of it like building financial freedom bricks one by one.
I like that.
Yeah, it's this intentional, deliberate process of creating an asset that can sustain itself over time. And that asset could be, a stock portfolio spitting out dividends, or it could be a fully automated print-on-demand shop.
Okay, so we have 15 pathways mapped out for you. And to make sense of all this info, we've grouped them thematically, really, based on what you, the listener, need to invest most.
Yeah, we've basically got 3 main buckets. First, we'll look at strategies that leverage existing capital and assets. These are the classic investment channels, where your money works to make more money.
Okay, the investment side.
Second, we'll shift into leveraging skills and creativity. These are the digital assets where you invest your time and know-how once, aiming for continuous returns.
Got it. Time and talent.
And finally, we'll dive into leveraging systems and marketing. These are the more automated business models that try to replace physical effort with, smart automation.
Oh.
This kind of structure should help you pinpoint where your main resource lies right now. Is it money, time, or a specific skill?
Makes sense. Let's start where the big money often plays.
Yeah.
Leveraging capital.
Oh?
All right, first up, the blue chip revenue stream, arguably the foundation for many long-term investors. Dividend stocks, path 1. I love the simple idea here, just owning a piece of a company that pays you, but isn't relying on those payouts a bit of a gamble? What if the company just decides to cut the dividend? How do the sources say we should handle that fundamental risk?
That's absolutely the critical question, you're right. So picture it. You're buying a small slice of a huge, often very stable corporation. Think names like Coca-Cola or maybe Johnson & Johnson.
They household names.
Exactly. And they pay you dividends periodically, usually quarterly, because they're consistently making profits and they want to reward the people holding their stock long term.
Okay.
Now, to manage that risk you mentioned, the risk of cuts, the sources strongly suggest focusing not just on the yield right now, like the big percentage payout.
Which can be tempting.
Very tempting. But instead, focus on dividend growth stocks. These are companies with a proven history, often decades long, of increasing their dividend payout year after year after year.
Ah, okay. So you're not just chasing the biggest payment today. You're looking for stability and, more importantly, that track record of consistent increase.
Precisely. And this means looking a bit deeper. You need to understand the company's payout ratio. What percentage of their actual net income are they distributing as dividends?
Right.
If a company's paying out, say, 90% of its earnings, well, that dividend might be a bit shaky.
Yeah, not much room for error.
Exactly.
Yeah.
But if it's only paying out 35%, they've got a huge buffer. And another thing the sources really hammered home was DRPs, dividend reinvestment plans.
DRPs. Okay, unpack that for us. What are they?
Okay, so a DRP is basically an option your brokerage firm offers. Any dividend you receive from a stock isn't paid to you as cash. Instead, it's automatically used to buy more shares of that same company.
Oh, interesting. So it just compounds automatically.
Completely automatically. You literally do nothing. The process is handled for you. You get the dividend. That cash buys more shares, maybe even fractional shares. Those new shares then generate more dividends in the next cycle, and the whole thing just snowballs.
Right.
That source analogy you mentioned earlier, planting a money tree that keeps giving you fruit every quarter.
Yeah.
Well, with DRIPs, you're constantly taking that fruit and using it to plant new tiny saplings. It just accelerates the growth of your whole orchard over time.
Okay, that makes a lot of sense for the long term.
Yeah.
Next up, the real classic, the gold standard maybe, of traditional wealth building. Rental properties. Path 2. This is that tangible asset everyone thinks of for passive income. But let's be honest, the reality of being a landlord, dealing with tenants, repairs, it seems anything but passive sometimes.
You absolutely hit the nail on the head there. This is definitely one of the oldest, most reliable passive income streams mentioned across the board. But we have to distinguish between leveraging your capital to buy the asset and the active management that's often needed to keep it truly passive. The basic idea is simple. Generate monthly income from rent checks. The huge catch, though,
The cost.
the significant upfront investment, the down payment, getting financing, closing costs, it adds up fast.
So, assuming you get past that hurdle and you actually own the property, how do you make it genuinely passive? How do you avoid those late night calls about leaky toilets?
The sources are very clear on this.
Yeah.
You outsource the management.
Okay.
If you are the one personally handling repairs, chasing down late rent payments, scheduling maintenance, then yeah, it's basically a part-time job, not passive income.
Right.
The truly passive approach means budgeting maybe 10%, sometimes a bit more, of your gross rental income to pay a professional property management company.
So that fee is essentially buying back your time.
It's the cost of your time and your peace of mind, exactly. The sources also mention considering different rental models beyond just standard long-term leases.
Like Airbnb.
Like Airbnb, or maybe higher-end short-term furnished rentals targeted at corporate clients or traveling professionals. These can potentially boost your yield significantly. But they also tend to increase the active work needed, more turnover, more cleaning, more communication, unless you have that side fully managed as well. So it's always a trade-off. High touch, maybe higher yield versus low touch, reliable passivity.
Okay, so maybe you're not ready to buy a whole building, or you just don't want to deal with property managers at all. This is where it gets, I think, really interesting for a lot of people. Let's talk REITs. Path 3, real estate investment trusts.
Yeah, REITs are fascinating because they solve both of those big problems. The huge barrier to entry financially and the headache of being a landlord.
How so?
They basically let everyday investors participate in large-scale, income-producing real estate. We're talking shopping malls, data centers, big logistics warehouses, office towers.
Stuff you couldn't buy on your own.
Exactly. And you get exposure to the income from these properties without ever having to screen a tenant or fix a leaky faucet. They really democratize real estate investing.
So you're essentially buying shares, like a stock, but in a company that only owns and operates real estate.
Pretty much, yeah. A highly specialized company.
But why do they tend to pay such high dividends compared to, say, a regular tech stock? Is there something specific in how they're set up? A legal thing?
Yes, that's the crucial detail that makes them such a good tool for passive income seekers. It's baked into the regulations. To maintain their special REIT tax status, these companies are legally required to distribute at least 90% of their taxable income back to shareholders as dividends.
90%, wow.
Yeah. That legal requirement directly links the high dividend payouts to the rental income being generated by the actual physical buildings they own. It's a mechanism built right into the tax code that really favors investors looking for that regular income stream.
Okay, that explains the consistency and the often higher payouts.
It does. And it's also worth noting quickly, there's a difference between equity REITs, the ones that own the physical property and collect rent and mortgage REITs, or M-REITs, which deal more with the financing side, mortgages, and mortgage-backed securities.
Which one is better for passive income?
Generally, for the typical passive investor focused on stability and consistency, the sources lean towards equity REITs. They're backed by the tangible asset, the building itself, and tend to be less volatile or sensitive to interest rate swings compared to M-REITs.
And you can buy them easily.
Totally. Through any standard brokerage account. It's probably the most accessible way to get into the real estate market, literally from your phone, as one source put it.
Okay, staying in the financial markets for a bit longer, let's jump ahead slightly to index funds, Path 14. This one came up a lot in the sources as, like, the ultimate starting point for beginners wanting effortless passivity.
Yeah, index funds are really foundational. They're incredibly simple in concept. They are just large baskets of stocks, sometimes hundreds or even thousands, designed to basically mirror the performance of a broad market index. Think the S&P 500, which tracks the 500 largest U.S. companies, or maybe a total U.S. stock market index.
And the safety comes from not putting all your eggs in one basket.
Exactly. It's inherent diversification. If one company in the index has a terrible quarter and its stock drops, the other 499 or maybe 3,000 stocks in the fund help cushion that blow. You're essentially betting on the overall long-term growth and productivity of the entire economy.
Which historically has been a pretty good bet.
Extremely reliable over decades, yes.
Now, I know they're often called set it and forget it, but surely there's some initial homework needed. It can't be completely passive without any thought up front, right? What diligence does a new investor need to do?
That's a fair point. It's low effort, but not zero effort initially. You really need to understand two main things. First, expense ratios.
Okay, the fees.
The fees, exactly. Since these funds are managed by financial institutions like Vanguard or Fidelity, they charge an annual fee. It's expressed as a percentage of the assets you have invested.
And that matters because
you're planning to hold these ideally for decades, right? So even a seemingly tiny difference in that expense ratio, say 0.5% versus 0.05%, can literally cost you tens, maybe even hundreds of thousands of dollars in lost returns over 30 or 40 years due to compounding.
Wow. So choosing low-cost funds is critical.
Absolutely critical. You should be looking for funds with ultra-low expense ratios, often well under 0.1%, sometimes even below 0.05%.
Okay, expense ratios. What's the second thing?
Second is just deciding which index you actually want to track. The common debate is often between, say, a total stock market index, which includes small and mid-sized companies, versus a pure S&P 500 fund, which is just the large caps. There are pros and cons to each.
But the core strategy is simple.
The simplest strategy, and the one most recommended for passive investing, is just setting up automatic monthly contributions into a low-cost, broadly diversified index fund. Put it on autopilot and let it grow with the market over the long haul.
That straightforward approach is quite different from our next one. Let's talk about something a bit newer, maybe a bit riskier, but with potentially higher returns. Peer-to-peer, P2P lending, Path 4. This is basically becoming a mini bank through online platforms.
Yeah, that's a good way to think about it. The mechanism is you're lending your money online directly to individuals or maybe small businesses who are looking for loans. Often they're using these platforms because they might not qualify for traditional bank loans or the terms are better.
Okay, and the passive part is the platform handles all the admin.
Exactly. The platform handles the heavy lifting, vetting borrowers to some extent, processing payments, dealing with the legal agreements, managing collections if necessary. Your role as the lender is mostly hands-off once you've allocated the capital.
Okay, but wait. The sources definitely flagged defaults as a major risk here. So calling it hands-off, isn't that a bit misleading? Don't you, as the investor, still need to be actively choosing loans or at least understanding the platform's risk?
You're absolutely right to push back on the pure hands-off idea. While the day-to-day transaction is automated, the intelligence, the active part for the investor, lies in risk management.
How do you manage that risk?
The main strategy the platforms enable is fractional investing. So instead of lending, say, $10,000 to one single borrower,
which would be very risky.
Very risky. Your capital is automatically spread across maybe hundreds of tiny pieces of different loans, sometimes as little as $25 per loan slice.
Diversification again?
Exactly. It strategically mitigates the impact of any single borrower defaulting. If, say, 3 or 4 borrowers out of your 300 loan slices default, It hurts, but your other 290-something borrowers are still making their interest payments.
So the investor's active role isn't picking individual loans day to day, but more about choosing the platform wisely, understanding how they assess risk, and maybe setting criteria for the types of loans you want to fund.
Precisely. You're relying on the platform's algorithms and diversification tools. P2P lending generally offers a higher potential return than something safer, like, say, high-quality bonds. But that higher return is explicitly pricing in the higher risk of borrower default.
Makes sense.
So you're leveraging your capital for interest payments, but you definitely need to monitor the platform's overall performance and default rates, especially during economic downturns when delinquencies can spike quite sharply.
Okay, that wraps up our first big category, using money to make money. Now let's totally switch gears. All right, so if you don't have a big pile of cash ready to invest, this next group of pathways focuses on investing your time and your knowledge. Investing it once, ideally, to create something that can generate income ongoingly. First one, online courses, Path 5.
Yeah, and what's really interesting here is the barrier to entry isn't necessarily having some PhD level knowledge. The prerequisite is just being genuinely proficient at something that other people want to learn.
Like what? Give some examples.
Oh, it could be anything. Practical skills like photography, maybe advanced Excel spreadsheets, how to play guitar, baking sourdough bread, even something like public speaking. If you know it well and can teach it clearly, there's likely a market. The key is packaging that expertise effectively.
Right. Everyone probably has some skill they kind of take for granted that others would pay to learn. But let's be real, the online course market feels incredibly crowded these days.
Yeah.
The idea of uploading it once and kicking back sounds great, but how do the sources suggest actually getting noticed? How do you overcome that saturation?
That's the million-dollar question, isn't it? The sources really stress two things here: niche specificity and having a strong launch strategy.
Okay, niche down.
Exactly. Instead of creating a super broad course like photography basics,
Everyone does.
which everyone does, focus on something much more specific like advanced drone photography techniques for real estate marketing. See? The market is much smaller, but the demand from that specific professional group might be really high, and they might be willing to pay more.
Okay, find your specific audience. What about the launch?
Right. Success isn't passive right away. It only becomes passive after a pretty active and intense launch period. You need to really understand platform SEO, search engine optimization.
So people can find it.
Yeah. Optimizing your course title, your description, the keywords you use on platforms like Udemy or Skillshare so your course shows up high when people search for that topic. And you might even need to run some paid ads initially just to get those first few students in, get some momentum, and hopefully get some positive reviews.
So the passivity comes from the platform handling the hosting, the payments, the delivery, but you still have to actively market it, especially at the start, to get it seen by the platform's algorithm.
Absolutely. Once it's established, you earn every time someone enrolls, potentially for years. But the content itself really needs to be evergreen.
Meaning?
Meaning it should focus on fundamental principles or skills that don't change rapidly. If you make a course about, say, the latest version of some software that gets updated every 6 months.
You're signing up for constant updates.
Exactly. That introduces active work again. The best passive courses tend to have high production quality, obviously, but also address skills or knowledge that have enduring relevance.
That leads pretty naturally into the next one, which is also about packaging expertise, but in written form. Writing an ebook, Path 6.
Yeah, similar idea. Whether you've got a compelling story to tell, maybe fiction, or a specialized how-to guide based on your experience, an ebook is probably the quickest way to turn that knowledge into a tangible digital asset.
And the big player here is Amazon.
Overwhelmingly, yes. Amazon Kindle Direct Publishing, or KDP, the barrier to actually publishing is almost zero. You format your manuscript, design a cover, upload it, set a price, and you're live in their global marketplace.
But again, similar problem to courses, right? There are literally millions of ebooks on Amazon. How does an author make their book stand out and keep selling passively for years, not just disappear after launch week?
Right, discovery is key. The sources emphasize a few things. First, optimization. Just like with courses, the title, the subtitle, the book description, they all need to be packed with keywords that real readers are actually typing into the Amazon search bar.
Okay, search matters. What else?
The cover. The book cover quality is absolutely non-negotiable. In that crowded digital space, it's basically your entire storefront. It has to look professional and convey the genre or topic instantly.
Makes sense.
And a really smart, truly passive strategy mentioned was using the ebook as part of a larger sales funnel.
How does that work?
You might sell a short, very specific, helpful ebook for a low price, maybe $2.99 or $4.99. But inside that book, maybe in the conclusion or an appendix, you promote a higher priced product. That could be your comprehensive online course on the same topic, maybe a coaching service, or another related product.
So the cheap ebook acts as a filter and a lead generator.
Exactly. It becomes an automated, low-cost way to find interested people and introduce them to your more valuable offerings. You're leveraging those small, passive ebook sales into potentially much larger opportunities down the line.
Clever. Okay, next, let's look at monetizing content you might already have or could create relatively easily if you have the skill. Stock media, paths 9 and 10. This feels like pure passive licensing. Let's break it down, starting with stock photos, path 9.
Yeah, this is great if you're already a decent photographer, even a hobbyist with a good eye, or maybe skilled with digital art tools. You can basically turn your existing photo library or new work you create into a passive income stream.
How? Where do you put them?
You upload high-quality, technically sound images, good resolution, sharp focus, well-composed to stock photo platforms. The big names are Shutterstock, Adobe Stock, Getty Images, places like that. These platforms act as massive global marketplaces connecting you with buyers.
And who's buying these?
Businesses, marketers, web designers, bloggers, news organizations, anyone who needs images for their projects but doesn't want to commission custom photography.
What kind of photos actually sell well now? Is it still just like pretty landscapes and smiling business people?
Not so much anymore, or at least those are incredibly saturated categories. The real demand now, according to the sources, is for more specific, authentic, and maybe conceptual imagery.
Like what?
Think high-res photos of diverse groups of people genuinely interacting with specific technology, or realistic workplace scenarios, not the cheesy old ones. Or even abstract concepts, visualized images representing data security or global supply chain or mental wellness.
Okay, more specific and usable.
Exactly. And the revenue model is typically micro royalties. You earn a small amount, maybe cents or a few dollars, each time one of your photos is downloaded. But a popular photo could be downloaded hundreds, even thousands of times over its lifespan.
So the key is volume and quality.
Volume, quality, and diversity. The key to making this truly passive is building up a large, diverse portfolio of high-quality images that meet those specific demands. The more niche, in-demand images you have uploaded, the wider you cast your net for those ongoing passive royalties.
Okay, path 10 is very similar, but for sound. Music audio licensing, aimed at musicians, producers, sound designers.
Precisely. Same concept, different medium. This is where musicians or audio creators upload their work. Could be instrumental background tracks, jingles for ads, sound effects, atmospheric soundscapes, even short musical loops or beats.
Where do they upload these?
Platforms like Epidemic Sound, Artlist, Pond5 are big players here. And the customer base is huge and growing. Think podcasters needing intro music, YouTubers needing background tracks for their videos, filmmakers needing sound effects, app developers, advertisers.
Anyone creating content, basically.
Pretty much anyone creating digital content who needs music or sound that's legally cleared for them to use, often commercially. They typically pay a subscription fee to the platform for access, and the creator, you, receives royalties based on how often your tracks are downloaded or used.
So again, it's that upload once, get paid potentially forever model, leveraging copyright.
Exactly. A single, high-quality, versatile piece of background music, maybe something loopable and unobtrusive, could potentially be licensed thousands upon thousands of times over many years.
What's the active work involved here, just making the music?
The active work is crafting a portfolio of music or audio that is specifically designed for commercial use. This often means instrumental tracks, very high production value, and adhering to the quite strict technical and quality standards of these platforms. But once your portfolio is created, uploaded, and accepted, it becomes this durable, passive inventory working for you 24/7.
Okay, let's shift to something a bit more technical now. Building an app, path 11. This one might sound intimidating to a lot of people, like you need to be a coding genius.
Yeah, it definitely can sound that way. And look, this pathway does require either specific technical skills yourself or the capital to hire a developer to build it for you. That's the upfront investment.
But the sources suggested focusing on simplicity, not trying to build the next Facebook.
Exactly. The goal here isn't necessarily to build some huge, complex, venture-backed mega app. It's often more achievable to focus on creating a simple, niche utility app, or maybe even a very basic game.
Like what kind of utility?
Think of specialized calculators for a specific industry, maybe a checklist manager for a particular hobby, simple habit trackers, or niche educational tools that solve one very specific, persistent problem for a defined group of users.
Okay, solve one small problem well. And then how does it become passive income once it's in the App Store?
Right. Once the app is developed, tested, debugged, and listed on the Apple App Store or Google Play Store, the revenue streams typically come from either in-app advertising or through subscriptions or one-time purchases for premium features.
And the App Stores handle the distribution and payments.
They handle everything: the hosting, the global distribution, the payment processing, currency conversions. That's the automated part. And for a simple utility app, once it's stable, the ongoing maintenance burden can actually be relatively low compared to constantly developing new features for a bigger app.
How do you monetize effectively then? Ads or payments?
The sources often point to the freemium model as a good passive strategy. You offer a solid free version of the app that provides core value. This generates revenue from ads shown within the app. Then you offer users the option to upgrade maybe a one-time purchase or a small monthly annual subscription to unlock premium features, remove the ads, or get extra content.
So the free version draws people in.
Draws them in, gets downloads, generates ad revenue passively. And a percentage of those users will convert to paying customers for the enhanced experience. This turns that initial, potentially significant coding effort into a potentially steady, reliable income stream over time, provided the app remains stable and continues to solve that specific user need.
All right, our final category. This is all about leveraging smart systems, automation, and marketing to essentially replace the need for your direct physical labor or constant sales effort, turning influence or curation into currency. First up, affiliate marketing. Path 7.
Yeah, affiliate marketing. The basic idea is you recommend products or services that you genuinely use, trust, and like. You share these recommendations within your existing content. Maybe it's a blog post reviewing a product, a YouTube tutorial showing how to use something.
Could be social media too.
Could be, yeah. And the company gives you a special, unique tracking link. When someone clicks your link and then makes a purchase, the company tracks that sale back to you and you receive a commission.
Okay, sounds pretty straightforward, almost easy.
Right.
But that context you mentioned within your existing content seems crucial for it to be passive, right?
Absolutely paramount.
Because if I'm just starting out and I'm just spamming affiliate links on Twitter hoping someone clicks, am I really doing passive income? Or am I just doing active, probably unpaid sales work until I maybe build an audience?
No, that's the critical distinction. You've nailed it. If you are constantly having to create new content just to push affiliate links, constantly chasing new clicks day after day, yeah, that's active sales. It's a grind.
So when does it become passive?
It becomes truly passive when the content you created, say 3 years ago, maybe a really in-depth review of a popular camera on your blog that now ranks well on Google, or a YouTube tutorial for a piece of software that people search for constantly, when that old content continues to attract visitors and generate clicks and sales through your affiliate link without any new effort from you today.
So the passivity comes from search engines doing the work for you, surfacing your old, valuable content.
Exactly. The system leverages your established influence, your back catalog of evergreen content, and search engine optimization, SEO. That's the engine driving the passive income.
Okay. Did the sources talk about different types of affiliate deals? Like, are some better than others?
Yeah, they often distinguish between low-ticket and high-ticket affiliate programs. Low-ticket is typically high-volume, low-commission per sale. Think Amazon Associates. You might get a small percentage, maybe 3-8% on a $20 book. You need a lot of clicks and sales to make significant money.
Right.
High ticket is usually lower volume, but much higher commission per sale. This is common with software companies, online courses, financial services. Selling a $1,000 online course might net you a $300, $500 commission from a single click.
Wow, big difference.
Huge difference. The high-ticket stuff often requires more trust, maybe more detailed, authoritative review content from you to convince someone to buy, but the resulting passive commission when it hits is far more leveraged against your initial time investment in creating that content.
Interesting trade-off.
Okay,
next we have a really fascinating blend of creativity and logistics. Print on demand, Path 8. This is basically selling physical products like t-shirts or mugs without ever having to touch inventory yourself.
Exactly. It's brilliant, really. Your role as the creator is purely focused on the intellectual property, the design, and the marketing. You create graphics, slogans, artwork, whatever you think will sell on a t-shirt, a hoodie, a mug, a phone case, a poster.
Right.
Then you upload these digital design files to a print-on-demand, POD, company. There are many now: Printful, Printify, Teespring, Merch by Amazon is a big one.
And then what happens? How do people buy them?
You then typically integrate these designs with an online storefront. That could be your own Shopify store, an Etsy shop, or directly through the platform like Merch by Amazon. You create mock-ups showing what the final product looks like.
And the passive part is? The POD company does all the work.
All the physical work, yes. That's the magic.
Right.
They handle the inventory of blank products, the actual printing of your design onto the product only when an order comes in, the packaging, and the shipping directly to the end customer.
You never have boxes of unsold shirts piled up in your garage.
Never. You are simply the owner of the designs and the curator of the online store. You invest that creative time up front to make the designs. When a customer buys a t-shirt featuring your design from your Etsy shop, for instance, that order automatically gets routed to the POD company. They print it, ship it, deduct their costs for the blank shirt and the fulfillment service, and then they send the remaining profit margin directly to you.
What's the active work involved then beyond the initial design?
The ongoing active work, if you want to scale it, is usually market research, understanding current trends, what's selling, finding niches, and then creating compelling product listings, good mock-ups, strong titles and descriptions with relevant keywords so people find your stuff. But the core fulfillment, completely automated. It's a fantastic example of leveraging automation to completely remove the traditional barriers and risks of physical retail.
Okay, now let's talk about something that often gets confused with print on demand, but is quite different. Drop shipping, Path 13. This one also promises that no inventory dream, but the sources suggest it might be less passive than it seems.
Yeah, dropshipping definitely has a reputation for being an easy passive income route, but the reality can be more complex. The basic setup is similar in that you don't hold inventory. You list products sourced from a third-party supplier, often overseas on your own online store, like Shopify.
Hey.
When a customer buys that product from your store, you then turn around and purchase that exact item from your supplier, and you provide them with your customer shipping address. The supplier then ships the product directly to your customer. You basically act as the middleman, profiting from the price markup.
So again, no inventory for you. But the sources seemed really strong on the idea that the real work, the active part that never goes away, isn't fulfillment. It's managing the whole operation and the risks involved. Can you elaborate on that?
Absolutely. The active work in dropshipping is often intense, especially getting started. A huge part of it is marketing and advertising. You're constantly needing to test and optimize online ads, usually Facebook or Google ads, to find profitable ways to acquire customers. That costs money and takes skill.
Okay, paid traffic is key. What else?
Crucially, it involves supplier management and customer service. You have to find reliable suppliers, which can be tricky. You're the face of the brand to the customer. So if your supplier in China suddenly has 3-week shipping delays, or they send out a poor quality or damaged product,
The customer complains to you.
Exactly. You are the one dealing with angry customer emails, processing returns, handling refund disputes. You bear the reputational risk. So, while the order fulfillment itself is hands-off for you, managing the advertising, the supplier relationships, and the customer experience remains very active. The potential profit margin can be high once you get a winning product and system running, but the day-to-day maintenance and risk management can be quite demanding, much more so than print on demand usually.
Got it. Okay, moving into the content creation world again, but video this time. The YouTube channel, Path 12. Now, most people think of YouTube as requiring constant filming, editing, uploading very active work, but you mentioned earlier there's a surprising long-term passive element.
Yeah, it's an interesting one because the start is definitely very active.
Yeah.
You absolutely need high consistency, especially early on. You have to upload regularly to feed the YouTube algorithm, build an audience, meet the monetization requirements, watch hours and subscribers. That initial phase is a grind, no doubt.
Right.
But the passive element emerges over time through the power of your content library. Once videos are created, optimized with good titles, descriptions, and thumbnails, the sources highlight that your old videos, especially evergreen ones, can continue to rank well in YouTube search and Google search results for years.
So people keep finding and watching them long after you made them.
Exactly. And those old videos continue to generate ad revenue passively. This is often called the evergreen content strategy on YouTube.
So if I create a really good tutorial today on how to fix a common plumbing problem, or a historical deep dive, or a review of a classic piece of software, something people will likely still be searching for in 3, 4, 5 years.
Yeah.
Then that specific video becomes an enduring passive asset in your library. It keeps working for you, pulling in views and ad revenue, long after you've moved on to creating other things.
That makes sense. How do successful YouTubers manage the workload then to leverage this?
A common strategy is content batching. Instead of being on a constant treadmill of filming and editing every week, they might dedicate, say, 1 full week every couple of months purely to scripting and filming maybe 10 or 12 evergreen videos.
Get it all done at once.
Exactly. Front load that active work. Then they can schedule those videos to release gradually over the next 2 or 3 months. This allows them to step back a bit, let the existing library generate that passive ad revenue, maybe passive affiliate income from links in the descriptions, perhaps even merch sales, often fulfilled using print on demand, linking back to Path 8.
So the channel becomes passive through the compounding effect of hundreds of old videos still getting traffic.
That's the idea. It takes time and significant upfront effort to build that library, but once it's there, it can become a powerful, long-term passive income engine.
Very cool. Okay, finally, our last pathway, Path 15. This seems like a great option for strong writers looking for more predictable income. The recurring content model via a subscription newsletter.
Yes, this model really targets individuals who have strong writing skills and, crucially, deep expertise in a specific subject area that others find valuable.
What kind of subjects work well?
It could be in-depth market analysis for a particular industry that professionals rely on to make decisions, or advanced strategies and tips for a niche hobby like competitive gaming or specialized gardening, or curated news and insights for a specific professional field. The key is offering premium, specialized content that isn't easily available for free elsewhere, content that people are willing to pay a monthly fee to access.
And platforms like Substack make this easy to set up.
Exactly. Platforms like Substack, Ghost, Beehive, they handle all the technical backend, the website, the email delivery, the payment processing, managing subscribers. It makes launching a paid newsletter technically very straightforward.
The big benefit here seems to be the stability, right? That recurring revenue is often seen as the holy grail of passive income.
It absolutely is. People subscribe, usually monthly or annually, and that creates a consistent, predictable stream of income, which is very different from the potentially fluctuating income of, say, affiliate marketing or ad revenue.
What's the catch? What's the active work required here? Just writing the newsletter each week or month?
Writing the content consistently is the main active part, yes, but maybe more importantly, the ongoing challenge is churn management. Churn is the rate at which subscribers cancel.
Keeping people subscribed.
Exactly. While the platform handles the automated billing, you have to consistently deliver high-value content that makes subscribers feel they're getting their money's worth month after month. If the quality drops or the perceived value isn't there, people will cancel.
So it's passive in terms of income collection, but active in terms of ongoing value delivery.
Precisely. However, if you are providing truly specialized, actionable insights that genuinely save your subscribers time, help them make more money, or deepen their enjoyment of a hobby, they start to view that subscription fee not as a discretionary purchase, but almost as a necessary operational expense or a valuable tool.
And that leads to low churn and high predictability.
That's the goal. Once you've built that loyal subscriber base who rely on your expertise, it can become an incredibly powerful, high-margin, and relatively predictable passive income stream, built purely on leveraging your intellectual capital and writing skills. #outro.
Wow. Okay. So what does this all mean? We have covered a huge amount of ground here. Just jumping from things like owning a tiny piece of a huge company through dividend stocks, Path 1, all the way to basically outsourcing your logistics with dropshipping, Path 13, and then turning your writing into predictable monthly cash with a subscription newsletter, Path 15. It's a really broad landscape.
It really is. We've tried to synthesize options that cater to whatever primary resource you have available right now. We looked at investing your money through assets like REITs and index funds, which become highly passive once that initial capital is deployed.
Right.
Then we explored investing your time and creativity, things like online courses and ebooks, which demand that significant one-time active effort up front to create the asset.
Yeah, the build it once model.
Exactly. And finally, we covered leveraging systems and automation through strategies like affiliate marketing and print on demand, which rely heavily on technology and smart setup to generate revenue with less ongoing direct labor. There really is, hopefully, an idea in there for almost everyone.
And looking across all 15, what's the final, most crucial takeaway? Especially given that nearly all of them require that pretty significant upfront effort we kept talking about.
I think the key message, repeated across the sources implicitly or explicitly, is the power of starting small and, critically, staying consistent through that initial active phase.
Consistency is king.
It really is, whether that means consistently contributing just a small amount to your index fund each month and resisting that urge to constantly tinker or check it.
Which is hard.
Which is very hard. Or maybe it means consistently dedicating just 1 hour every single night after work to script out scenes for your evergreen YouTube video. That disciplined consistency is what ultimately transforms that initial, often difficult effort into the long-term, automated, passive result that we're all aiming for.
So don't get mesmerized by the big potential payout down the road.
Exactly. Don't chase the headline income figure. Chase the consistency of the effort required to get there. That's the controllable part.
We've laid out the map.
Yeah.
Essentially, we've shown the different roads. Now you, the listener, have to pick your starting point on that map.
Right. And maybe the final thought to leave you with, building on everything we've discussed, is this. Given that upfront investment, whether it's your time or your money, is unavoidable, here's the real question to mull over. Which of these 15 pathways we've outlined offers you, personally, the most potential leverage? Which one maximizes the ratio of that early, maybe painful upfront effort to the eventual automated passive return based specifically on your current situation and skills?
Interesting way to frame it.
Is your deep expertise in, say, niche market analysis right now, which might point towards a subscription newsletter or high-ticket affiliate marketing, actually more valuable, more leverageable than the amount of capital you have immediately available? Or conversely, should your initial focus be purely on building that solid financial foundation with simple index funds first, before tackling the more time-intensive creative projects?
So it's about figuring out your personal leverage point.
Exactly. Calculating where your unique skills, resources, and time can create the biggest impact with the least initial friction. That calculation is arguably the most important first step on your own passive income journey.